Hello and welcome to another episode of News of the Week, where we talk about what is going on in the economy and how does it influence us and impact us as real estate investors. So if you have paid attention to the news in the last week and the week before, we are currently in first quarter earnings season. And what that means is that all the different financial institutions, like most other companies that are publicly listed on the stock exchange, have or are in the process of reporting their earnings. And what we are mainly interested in, because we are dependent on them in the sense of providing money, is the banks. How did the banks do? And what the latest news actually shows begs the question, is the banking crisis over? You remember Silicon Valley Bank basically crashed and disappeared. Then Credit Suisse crashed and was bought by UBS, and other smaller banks are or were in trouble. So the question number one is the banking crisis over? And number two, how did the banks do and why? So the first thing is, what were the reports? And especially the big banks like JP Morgan Chase, Citibank, Wells Fargo, and so forth, they had brilliant results, amazing results, much, much better than most analysts had anticipated. Now, for you to understand why did they have such great results, why we are basically in a recession or about to get into a recession, we have high inflation, interest rates are high, and so forth. And the last part is actually why especially large banks have great results. Why is that and how does that work? Well, mainly if you think about how do the banks actually make their money. On the one hand, they bring in money from the Federal Reserve and they give that money out in the form of loans, credit card loans, car loans, mortgages, all kinds of loans for businesses. They give out lines of credit. So since everybody knows the Fed has increased interest rates, so the banks give out these loans for substantially higher interest than what used to be the case in like 2020, 2021, even 2022. So the banks charge higher interest. But that alone doesn't mean that's how they make money. What they really make money on is how much do they have to give back for anything that people put in the bank as a deposit. And if you look at your accounts, checking, I don't think anybody makes any kind of interest on checking accounts. And even in savings account, you make very, very little interest. What happens, and which is super, super unfair, and I think it's kind of part of news of the week, but it's also part of bigger news if you have never really been aware of it, is the banks are not being forced to transfer the increase in interest rates that they benefit from to their customers. So while they're giving out loans and mortgages for 8, 9, 10, 15, 20%, I mean, most of you may not know if you don't use credit cards that much, at least you pay them off at the end of the month as you should. But people who have quite a bit of debt in credit cards, now they're paying 18, 19, up to 20% interest because that's what the banks charge. And on the other hand, when money is being put in the bank, you get maybe 1 or 2% interest on your savings account and nothing on your checking account. And how do the banks make a lot of money? By that difference, right? They basically don't have to give almost anything back, or they should, but they don't give anything back in interest for deposits, and they charge a lot on interest from anybody who is taking a loan from them. So that's kind of like why their results were so good. Now, you also have to differentiate between really large banks like JP Morgan and Citi and Wells Fargo versus smaller regional banks, because the way the volumes that the really, really large banks can move are much, much bigger than smaller banks. But it's also, remember I mentioned at the start of this episode that we had the collapse of Silicon Valley Bank and Signature Bank. And what people thought they should do is, if you think about where is your money the safest? Well, there's the safest in banks that have already been rescued. So if you didn't have an account at Silicon Valley Bank or whatever the new name of that same bank is now, and you were to open an account and put your deposit in there, it would be 100% safe because the government has stated all deposits in that failed bank are covered by the government, even beyond the normal $250,000. So that's one kind of weird way of having it safe. The only other way to really know that you most likely have it safe, any form of deposit, especially anything bigger than $250,000, is when you put it in the biggest banks. And why the biggest banks? There is a term called system relevant banks, or banks that the country cannot live without. They're too big to fail. So supposedly the government is overseeing them and making sure that they're operating properly and work well and so forth. But when small regional banks or Silicon Valley Bank crashed, everybody said, why did this happen? And the answer was, well, people wanted their deposits and the bank didn't have enough money to give the deposits back. Well, the only ones who really have enough money in that kind of situation are the very biggest ones. And if they ever run out of money, for sure, the government is going to step in and say, your money is safe. So what has happened when Silicon Valley Bank basically and other smaller banks failed, people took their money out of smaller regional banks and credit unions and put it into these big banks. And now we're coming back. These big banks don't give you a whole lot of interest on your deposits, but they charge a lot on loans. And that's why they made so much money and their quarterly results were amazing, blowing everybody away. To the question, is the banking crisis over? The big problem that still exists is, number one, a lot of banks, big, small, and regional, have as a reserve by law bought treasury bills, and these treasury bills have lost a lot of value. They are way less valuable than what the banks paid for. But in their accounting, they have a way to say, okay, we keep these treasury bills until they are due. Some of them are 10-year, 15-year, 20-year, which is really only a statement. Because if you and I and everybody else were to go to the bank and say, I want my deposits out of the bank, the only chance that the bank would be able to pay is by selling these treasury bills, even if they originally had the intention to keep them until they mature. So they are allowed to make that statement that their intention is to not sell them, even though they would have to if we wanted our money. And because of that statement, they don't have to account for the loss. Otherwise, a lot of banks, especially medium-sized banks, would have losses in their earnings statement rather than profit. So it's basically, you could call it an accounting aspect. I don't want to say a trick, but it's an accounting thing. It's not the reality. But here's the other part why I think we haven't really seen the end of the banking crisis yet. All of us know that a lot of people during the pandemic got permission to work from home. Anything that had to do with any kind of office work that you could do with a computer or a laptop or something like that was allowed to go and work from home. And that means that in a lot of large metropolitan areas, a lot of the office buildings are 30, 40, 50% occupied. Now, that in and of itself only means that the owners of these properties don't get as much rent as they would if the thing would be fully occupied. But the real thing, what brings in the banks, is that these buildings were not paid for by whoever the owner is. These buildings were basically financed just like you and I finance our residential properties. We get a mortgage and we put 20% in and the rest comes from the banks. These commercial properties are similarly financed. Oftentimes, the down payment is even far less than 20%. Why is this relevant? In commercial properties, the term is not like in our properties 30 years. It's 2, 3, 5, maybe on the outside 7 years. And obviously, office properties have been bought and financed and changed hands just like residential real estate has many, many times in the last 10 years. So there is a certain percentage of all this commercial real estate and the associated commercial loans that come due. Some, quite a big chunk, is coming due this year. Some are coming due next year. Some are coming due the following year. And coming due means somebody had bought an office complex when it was fully occupied just before the pandemic. Pandemic hits, most people move out and only half of them come back. Now, the tenant still, which is typically companies, they still have to pay the rent for the space that they rented. But the underlying financing that came from the bank, that has to be paid by the owner to the bank. And now, if in 2023, you bought it in 2019, you had a 3-year term, and now here 2023, you have to refinance. If you got your financing originally, let's say for 3%, Now you have to pay 7 or 8%. And when your tenant says, okay, I don't need the whole space anymore, I may actually only want to rent half of the space or 40% of the space. So your building is half empty. The tenant is probably not going to renew for the whole space and your cost is doubling. Well, what will the owners of these buildings do? They will either declare bankruptcy or go into foreclosure. But what really the impact will be for the banks is that all these loans on commercial properties will go under, will go upside down. And none of the banks, to the best of my knowledge, have so far accounted for that in any way. So that's one part. Commercial real estate loans will really get in trouble. Then there is a huge portion of car loans financed by the banks. And as inflation is high, cost of living is high, more and more people just can't pay their car loans anymore. So the cars get repossessed, but the loans are still there. That gets trouble for the bank. And then there is all kinds of other things, like, for example, credit card loans that people cannot refinance. They cannot pay because inflation is too high and their wages have not increased. That is trouble for the bank. So there are many, many types of loans that the banks have on the books. And we are just starting to see a few little indications that a lot of these loans will go upside down. And so that's the reason why I believe the banking crisis isn't over yet. And the only cure to get rid of this threat would be for the Federal Reserve to massively reduce interest rates. But guess what? They really can't. Because if they were to do this, the first thing that would happen is inflation would skyrocket again. And it would destroy everything that they have accomplished by getting inflation to start coming down. If they lower interest rates, inflation will go up right away again. If they don't lower interest rates, then the banks go into trouble. So they're really between a rock and a hard place, as we say, but there is still turmoil coming because ultimately, if you're really, really honest, what these earnings reports for this week have shown is that there is kind of like a last hooray before we really have to pay the piper, so to speak. You know, there is this old saying, there is no free lunch. And what that means is you cannot go and increase almost double the amount of dollars in circulation within 3 years and think you get that for free by just going to the printer and print more money with nothing behind it. There comes a point where that is going to come back and haunt you. And we will see that point in one way or another in the next 12 months, I believe. Whether it's a recession or a financial crisis or more banks failing. And I'm not saying this to spread doom and gloom in news of the week. I want to point this out because it's the counterbalance to what we have been doing. Our residential real estate is, in hindsight, been the smartest investment you could do because we have 30-year mortgages that don't have to be changed. We have more and more people who want to actually and have to rent because they don't qualify to buy a place. So they become our tenants. And because there are more and more of them, supply and demand applies, which means the more people want to rent, the more people are willing to pay higher rent, which is also, when you look at the latest inflation data that came out, indicating how much of the latest inflation is in rent inflation. And it's not because landlords like us are greedy, but our costs have increased too. And they continue to increase as long as interest rates are as high and as long as inflation is high. But from an investor perspective, we are in the perfect investment. And that's why I tell everybody who is a member of the tribe and anybody who is listening and watching News of the Week, if you're not already in it, you should start getting into residential real estate because that's the area that will be the safest, best performing for quite a few years to come. So thank you and stay well, be safe, and I see you in the next episode.